Good morning. My name is Martin Pelche. I'm a portfolio manager and family chief investment officer here at Trivest Wealth Counsel. Today I'm going to provide a brief recap of the markets and what's transpired in the third quarter and 2018 to date, in addition to providing some of the areas that we see some opportunities looking forward for investors. So to begin, overall this year is proving to be a fairly flat to down market globally, with the exception of one particular area. So despite all of the press that we're reading about new highs being set, overall this has kind of been a blah year in the markets. What I mean by that is if you take a look outside of the United States, every other global market is flirting with break even this year. So global bonds this year are down almost about 0.5%. Take a look at the EFI markets, they're running flat at 0.8% thanks to a 1.2% drop in the third quarter. Here in Canada, the TSX fell 0.6% in the third quarter, so bringing its year-to-date gain at 1.4%. Taking a look at emerging markets, it's been awful there. Despite higher oil prices, it's dislocated from that historical relationship, and it lost 7.7% in the third quarter, bringing its year-to-date loss to almost 5%. When looking at the United States, it's a different story. It had a pretty good quarter in the third quarter, thanks particularly due to the FANG stocks, which have contributed to 76%, so over 3/4 of its gains this year, pushing its gains this year into the low double digits in Canadian dollar terms. But when you strip away the FANG exposure, you're getting a very similar low rate of return, low single-digit return in the U.S. When you look at global markets, adding in bonds, international diversification, you're running in, again, a flat to low single-digit 1 to 2%. So, overall, nothing to get too excited about. However, that said, investors in the United States are herding into those FANG stocks, not surprisingly, given the outperformance that we're seeing in that area of the market. And so, as a result, cash positions in the U.S. among U.S. investors are back to record lows. For example, investors had in 2009 a cash position in the U.S. at 25%. Now it's down to flirting with 10%. So almost a record low, back to where we saw prior to the financial crisis drop. Looking at where we see some opportunities to position in, rather than return chasing, it's unbelievable the value gap that we're seeing in Europe, for example. European stocks are trading at 14 times forward earnings, and you compare that to the S&P 500, that's 18.5 times. That gap in a PE ratio is the largest it's been since the 1970s. So who'd have thought that there'd be a great value opportunity in Europe? Looking here closer to home in Canada, investors are looking at the Bank of Canada and saying, wow, now we've got NAFTA behind us, which is fantastic. Now we've got some positive indications on the economy, what's transpired in the housing market and the energy recovery. There's an expectation among pundits and economists that we're going to see material and aggressive rate hikes by the Bank of Canada. And that is not good for dividend-paying companies or interest rate-sensitive companies, such as in the telecommunications, financial services, and utility sector. But we think it's probably overdone. Some of these blue chip companies are off as much as 30% and have a dividend yield of 6%. So investors are saying, well, we probably want to hold off, sell these interest rate sensitive stocks, and maybe get back in the bonds when interest rates are significantly higher by the Bank of Canada. However, that said, looking forward, not backwards, we're seeing some risk that the Bank of Canada may be a little too, or the expectation that they may be too aggressive with their outlook, especially considering housing market in Vancouver and Toronto appear to be rolling over, and we're seeing that in sales. Energy trade is already done, so where is that growth going to come looking forward, especially when we've seen pervasive tax hikes here in Canada by the federal government and provincially, both on small business and individuals on the income tax level. And then looking at the U.S. Corporate tax cuts, that could impact Canada as well too. So we see some pretty good opportunities in that area of the market on the expectation that the Bank of Canada probably is not going to hike as much as many people expect. So there you go, a flat year in the markets, but that's okay. That creates opportunities for those longer-term investors, and also, most importantly, maintain appropriate diversification into some of those areas that we see some pretty good value opportunities. That's a wrap up for this quarter, and please stay tuned for more updates going forward. Thank you very much.